Hello everyone and welcome to Conceptnomics. I am Joy and today we will be discussing about input tax credit under the GST regime. Before we move to input tax credit, let us first understand what is GST. GST or Goods and Services Tax is an indirect tax which is levied on purchase of goods and services. GST has replaced a lot number of indirect taxes that existed before the GST regime to create a single taxation system in the country. Like for example, there was services tax, sales tax, luxury tax, a lot number of indirect taxes existed before. But GST has replaced all of them to create one single taxation system in India. And therefore, GST has streamlined taxation in India and has also created a unified common market in the country. More than 160 countries around the world have adopted GST or similar taxation systems because of its simplicity and also ease. So we can say that GST is a single tax on supply of goods and services right from the producer till the end consumer. Now coming to input tax credit mechanism under the GST. From a producer's perspective, input tax credit means that when the producer is paying taxes on the final output, he can reduce the taxes he has already paid on input. To make it more clear, let us take an example to understand this. For example, a producer producing mobile phones. Suppose he pays taxes on inputs. Like for example, there would be many raw materials he would need in the production of the mobile phone. So on these inputs, when he purchased these inputs to make the mobile phone, he would be paying taxes for these inputs. Now, there would also be a tax on the final good, that is the mobile phone. For example, suppose he is paying 500 rupees taxes on the inputs of the mobile phone, and at the end for the final product, that is for the mobile phone, he pays a tax of 1000 rupees. Now input tax credit means that while the producer pays taxes to the government on the final product, that is on the mobile phone, that is 1000 rupees, he can reduce the taxes he has paid on inputs, that is 500 rupees. So he needs to make a payment of only 1000 minus 500, which is 500 rupees to the government. This is the mechanism of input tax credit. You must be knowing that GST is an indirect tax, which means that the monetary burden of taxation falls on the consumer, but it is directly paid to the government by the producer. That is, the impact and incidence of taxation falls on two entities. So in case of our mobile phone example, the producer is the entity which makes the payment to the government and he recovers the amount tax from the consumer. So when the producer is paying the taxes, final taxes for this mobile phone or the end product to the government, he can make deductions of the taxes he has already paid on the inputs. This is input tax credit. And now there is an exemption for input tax credit, that is composition scheme under the GST. Those producers who have opted for composition scheme under the GST cannot make use of the benefit of input tax credit. So now what is composition scheme? Composition scheme under the GST is a very easy, procedure friendly and also a simple mechanism through which the small businesses, that is the MSMEs, can file their tax returns. That is, those entities or those businesses earning a turnover of or having a turnover of less than 1.5 crore rupees per annum can opt for the composition scheme. Now, what is composition scheme? Under the composition scheme, the small businesses having a turnover of less than the threshold have to pay their taxes or file their tax returns only quarterly, which makes the filing of taxes easy for them. There are certain conditions for opting into the composition scheme. First one, only the producers of the goods can opt for composition scheme, not services, which means services are exempted from composition scheme. Secondly, there is a turnover threshold which is 1.5 crore rupees per annum. Only those businesses having a turnover of less than 1.5 crore per annum can opt for this. Thirdly, composition scheme is applicable only for intrastate transactions, and the e-commerce firms cannot opt the composition scheme. So these are the conditions to opt for a composition scheme, and those producers who have opted for the composition scheme cannot opt for input tax credit. It is either the input tax credit or the composition scheme. So that is briefly about input tax credit. Thank you so much for watching. If you like the video, please do share it with your friends as well. I'll see you again with the next video. Thank you.